All right, so we're looking at the NASDAQ futures March delivery contract, and this is a trading view chart, and this is a weekly chart. And I want you to think about each week before the new trading week begins, preferably on the weekend. The idea is you want to try to get a read on what you think that next weekly candle is going to do. Is it going to go higher or is it going to go lower? You're not trying to predict the close of the weekly candle. That's important. You just want to see before this weekly candle opened up, all we had was this indecisive candle. Do you think that this candle that would have formed and opened here is more likely to go higher or lower? And that's the component I want you to focus on with your analysis. What is the market likely to draw to? When I say draw to, think of it as price being a paper clip. And then you have this magnetic impulse that specific price levels and seasonality put on price. It'll cause price to gravitate towards certain levels. And the measure of speed and magnitude that it moves to get to these levels, you learn that over experience. That's not something I can transfer. It's something you have to practice and see and study, and you get a rhythm for it. In the early stages of your development, you want to at least try to focus your attention on where that weekly candle is going to do. Now, here's the thing. It may start the first half of the week, or maybe just one day, expand lower. And if you get it set up in that, that's it. You're done. That's how you start working towards consistency. So the only thing you're looking for is a likely movement higher or lower based on the weekly candle. Okay, that's all you're doing. That sets your initial bias for the week. On the daily chart, you're looking for swing highs and swing lows to get your liquidity. And majority of your trading and the draw on liquidity, what makes the market go higher or lower, it's predominantly found on this time frame. Okay, so majority of your analysis should really be linked to this time frame right here. You have to have an assumption whether you're going to be expecting that weekly candle to expand higher or lower. That's your weekly bias. But then you have to go into the daily chart and figure out basically where you are in the grand scheme of things on that weekly range expanding higher or lower. Because we're looking for lower prices and we're looking for weakness, the expectation is we want to see every short-term low, like this would be a short-term low, this will be a short-term low, and underneath those lows there's going to be sell stops. Okay, that's liquidity. When I say learn to start looking for where the market's going to draw to, it's drawing to one of two things. Okay, it's drawing to stops, which is liquidity, or it's running to an imbalance. Now, what's that mean? Above old highs, buy stops. Below old lows, sell stops. Imbalances is something like this over here, where you have one single candle pass higher, and the previous candle's high is here, and the next candle's low is here. So it only went up one candle, nothing moved down to overlap with that same delivery on that price candle there. So in other words, that's an imbalance. It's only going higher and nothing else is here to offset that and efficiently deliver price on the opposite end. So we're looking for lower prices. We're looking for an expansion. We're looking at the daily chart. And we're going to drop down into the hourly chart. Okay, now what I have here is a framework for looking at the weekly range on an hourly chart. So all I did was beginning on midnight New York time, Monday's candle, and then Friday's close, and then the beginning of Friday's trading at midnight. Now, what I'm delineating here is the fact that we had a nice sell-off on Thursday, and the market went into consolidation overnight. Notice what happens here on Friday. This is that old low on the daily chart. That's what we're thinking and we're assuming that it's going to draw to, because that daily chart, there's lots of liquidity. And large fund traders, large institutional traders, institutional mindset investors will be looking at these old lows and old highs. And liquidity providers will be looking to take business in around these same levels. So if we know that this level down here is the old daily low, and again, let me take it back up to the chart on the daily chart. That's this low right here, okay? By dropping down into the hourly chart, that level is here. All I'm doing is transposing those daily levels right to this hourly chart. The entire week has been bearish. Okay, it's been going lower since the beginning. Then we had consolidation in here. The market creates this short-term high and this short-term low. What rests above that short-term high? If you've taken notes and been paying attention, it's buy stops. What's resting below this low here? Sell stops. Watch closely. The market trades down initially and takes out the sell stops. Why would it do that first? This is inducing shorts. Okay, so it engineers liquidity. Even if the idea is that they want to take the market down to this level, if it's been consolidating, I like to see them do this type of move here, where it drops down first. It's kind of like a sucker play. Anybody that has a sell stop below here, they want to sell on weakness, they're going to get tricked into the marketplace. So now they're triggered in short. And then they start doing a run against those traders and against those that were already short from this high. So what are they doing? The market's being driven higher, and the algorithm is going to attack that buy stop liquidity pool. Why would they want to do that? Number one, it's going to punish those individuals here that went short. When it drives above this high here, it sends all those buy stops into market orders, flooding the marketplace. That gives a huge influx of willing buyers at a high price, which is the perfect counterparty to smart money that wants to sell at a high price. Remember, the market wants to go down here. So when it drives up to here, those buy stops are the counterparty or the other side of a smart money trader that's wanting to go short, because they're going to sell short. They got to sell it to somebody who wants to buy it at a high price. That's why the market does this. In your notes, you want to record anytime a significant price move lower is expected, always anticipate some measure of a stop hunt on buy stops or a short-term high being taken out. Obviously, it's reversed when you're looking for higher prices. Generally, you'll see a short-term low taken out and sell stops taken before you see a very pronounced rally higher. Don't take my word for it. Go through to your charts and you'll see it's actually occurring almost on a daily basis. So we're going to drop down into a 15-minute time frame. So that same old low level down here, and that high I just mentioned on the hourly chart and the low on the hourly chart is now been defined with a small little line segment. Okay, so we have a trend line here and a trend line here. That's the extent of the trend line. That's it. I only use them to highlight to my students. These levels are not on my chart. I'm watching a naked chart. You, while you're developing, you should have these levels drawn out on your chart because it helps you build and ingrain the idea that this is where liquidity is. It keeps you focused on that because it's easy to look at all these candles forming if you have the luxury of watching it in live, and you can lose sight of where you are. I mean, once you lose your bearings, it's really confusing, and this helps you keep those bearings in mind. And what do I mean by that? Well, I mentioned how the market dropped down initially, and that takes the sell stops out. So sell side liquidity has been attacked. Traders are now tripped in going short if they sold on a break, trying to be a breakout artist. And then the algorithms go right back up to an area where it's been cleanly delivered relative equal highs. See how this high here, right before it dropped, is basically the same high here. Notice that? So retail traders see this and they trust it as what? Resistance. So the books always say, put your buy stop, if you're going to go short, right above a clear level of resistance. Well, these levels work for a short period of time, but majority of the time, you see this event right here. And this is how I teach my students to go in there and look for those types of events, because what did I just tell you moments ago about looking for significant price moves? Before there's a significant price move of any real magnitude or importance, generally there's going to be a stop hunt that takes place right before that price delivery occurs. So what does it look like? You have relative equal highs, this high and this high. The market goes up when we're what? We're expecting lower prices on that weekly chart. We're on the last day of the week. It's already been heavy. It's weak. And the only thing it's been doing is consolidate. And the first thing it did was broke out to the downside, tripping what? Traders in a breakout to go short. So now they have traders caught on the wrong side, offside, and now they want to take the market up here, where those buy stops are going to be resting for those that were smart enough to sell short here or here and didn't get out below here. So the larger pool of liquidity is going to be resting here because it's in sync with the downtrend. And everybody that was short the day before, they seen this high form, and once it broke below this low here, they all rushed and trailed their stop loss right above that. But this pool of liquidity, once this occurs, you want to drop down to your lower time frames and start looking for something specific. And let's go into those lower time frames and find out what that is. Okay, here's a 2-minute chart. Why a 2-minute chart? Well, 2 minute, 1 minute, or 3 minute, or 5. 5 minutes still has a lot of room for imbalances to occur underneath that time frame. And what do I mean by that? The 1 minute, 2 minute, 3 minute chart tends to be the best for finding the imbalances for indices. Okay, don't take my word for that. Okay, if you're looking for high frequency setups intraday, the 1, 2, or 3 minute chart, they just offer a real good clarity. The reason why, because the high frequency trading algorithms are operating on nothing really higher than 3 minutes. But majority of the time, they're like seconds. Okay, 15 second, 30 second, 45 second, 60 second intervals. Okay, and what they're looking for are these small little imbalances. And what does that look like? Well, we had that run on the buy stops here. Okay, remember that? Old high here, the old high here, old high here. It runs right on through that. Once this occurs on that higher time frame, 15-minute time frame, you want to drop down to the lower time frames. And I'm using the 2-minute chart because this is exactly what I was using to find that imbalance. The market creates a short-term low here, and then it breaks below that. This is key. This is called a break in market structure. Now, the foundations and underlying framework is we're in a market that's what? Weekly bearish. We're expecting that weekly candle to expand lower. It's been expanding all week. So we have momentum on our side. We have a consolidation that's occurred, and we had a pool of liquidity engineered with these relative equal highs, and the market broke out to the downside first, and then they ran on the highs. So once it went here, We don't rush in there and just go short because it went above the old highs. We're looking for some specific signature that tips its hand to you, okay? And I promise you, when you start going through your charts, and it's going to be homework for you, you're going to see this occurring almost every single day. And if it's not doing it this way, it's doing it the opposite direction as a buy. It runs the stops, then we have a short-term low, and then it breaks below it. So now we have a break in market structure. Once this low is broken, you're going to look for this little area here. That's that imbalance I mentioned in the beginning, right? So what's happening is the market's going to go right up inside that area there, and that's where you want to sell. Now, if you don't sell there, you can drop down to a lower time frame, 1 minute chart. If this was a 3-minute chart, you can go down to a 1 minute chart and look for that to occur on that time frame as well. And it many times will form if you're looking at a lower time frame, like say this was a 5-minute chart, and you looked at a 1 minute chart, you'd find one down in here. It's a matter of scaling down in your time frames, because once you have an underlying premise to the market now likely to go lower, it becomes an easy thing to look for these types of things. So in your chart, once you're developing this idea and learning it, you're going to highlight this candle's low, this candle's high, and this right here is what I teach my students as a fair value gap. The idea is once it go up into that imbalance there, and once it does that, as soon as it enters that area, the algorithm that delivers price, once you see these patterns over and over and over again, it's very easy to execute on them. This is what it looks like. This is what you're looking for, okay? These are the fingerprints of that setup. So if you know what they are and what those components are that make up this setup, you'll be able to find them. But focus on the imbalance after the market structure breaks. So this big candle here, it breaks down. Look at the next candle. It opens and trades higher and stops right there. So from this candle's low and this candle's high, when this candle starts trading, as soon as it opens and it runs right up into that, that's a short. You can go right in there, sell short, be done. Now, where's your stop going to be? Well, you can put it above this high here, or you can put it above this candle's high, whichever your risk parameters allow for. Looking at this further, we're going to look at the logic in here. And I want you to think about after this forms and you see that as your choice setup or entry. If it starts to move lower, you can still get in it. There's no reason not to think that you can't get in it here or in here. It's close to or in close proximity to where that area is as an entry. Once we take out a low though, once that occurs, then it becomes a matter of your chasing price. And if you try to get in, especially if you like use a market order, you may see it trade right to this low and say, okay, now I believe it's going to go down. You put a market order to sell short, and then slippage gets you down here. And it creates a larger area of risk that you have to assume. It's problematic. You want to learn to trust going short when the market's going higher, and that feels scary at first. But once you start seeing this pattern form, it becomes easy to trust it. And in fact, you want to be doing that. You want to be selling short, expecting lower prices right when the candle's going up. If you're looking at this framework here, and we've taken the buy stops, we have our entry pattern here, what would you be looking for as a downside objective? Well, I'm going to teach you the liquidity matrix. This here is your range. This is the low of the day, and this is the high of the day thus far. So if we take that range and split it from the low to the high to get the midpoint, all of this can be determined by a simple 50 level on a Fibonacci. So you drag your fib from this high down to that low or vice versa, and have your 50 level highlighted. Then anything above that 50 level, this is referred to from an algorithmic stance as a premium market. It means it's expensive. Now, markets can stay in a premium for a while and not go to a discount, which would be below the 50 point. Okay, 50%. Anything down here is a discount. If you're bearish, if you're ever going short, you want to look at the previous range. Where are you at inside that range? So when this formed here, that little fair value gap, once that formed, you're thinking, okay, we are in a premium. So algorithms will want to go to a discount. That's the opposing side of the marketplace. So if it's going short here, it's driving the market lower. What does that mean? The algorithm is going to start pricing lower. You can have all the buyers in the world come in. If the algorithm is in a sell program and it's going lower, it does not matter. It's going to reprice lower and lower and lower. And then what will happen is those buyers that may come in with a huge influx of volume, they're going to get crushed. So the market's moving from this premium high, this specific entry point, to a level below the 50 of this range, this low and this high. I want you to think about what below this level here, the 50 level, what is resting below here? Sell stops. So now think about the idea of someone like you and I that would see this ideal entry as a short. We have to sell to get in that short. How do we get out of that short? We got to buy it back or cover it by buying. Well, we're going to find willing sellers at a low price relative to this point here. They're willing already sitting down there with their sell stops right below that low. Now, look closely. What else resides right near that low? Right there is that imbalance I mentioned. Okay, it's only one single candle passing up, and the previous candle's high and the next candle's low. That area right there is an imbalance. From this area here, it went down below the 50 level and attacked these sell stops and completely closed in this imbalance. So every point of this candle's high to this candle's low, that range with the candle only going up, that's a buy side imbalance. It has to have an equal delivery to be efficiently priced and booked by the algorithm. It goes down and completely closes it back in with down movement. Notice the candle on this here, it opens and then trades down. So it fulfills its role of balancing the buy side offering, now the sell side offering. So that is an efficiently delivered price move. Precision elements from the entry here down to here. I basically just handed you an ATM machine. This repeats every single week. Every single week. These are simple elements that repeat. What you're looking for is a run on liquidity. Buy stops or sell stops. If you're bearish, you're looking for buy stops to be ran. Then a break in market structure, lower, a short-term low being broken. That's what it looks like right here. Short-term swing low. We have a candle high. A candle higher to the left with its low here. Then you have the low of this candle, and the next candle's higher low than this one. So you have a swing low formed. If you have that, and then you have a break below that, if it happens that creates a gap like this, that's what you're looking for. When it trades up into that, you can go short. Or if you want to use sell stops, you can use a sell stop in this candle here and just let it trip you in and then use the high of that candle as your stop.